Thank you, Dave, and good morning, everybody. I am thrilled to be with you here. It's amazing what we're dealing with this whole tariff news, right? And everybody's all worked up about it. In fact, I think there's been more of a buildup about this April 2nd, Liberation Day, that I can remember since the Gulf War, when the Saddam Hussein first invasion of Kuwait, when we had the ultimatum about about get out of Kuwait or else we're coming in, and it was like a 3 month buildup in that case. That was about the only other time I can think of something that was more of a buildup than this. Guess what the market did after the fighting broke out January 15th in 1991? The market went up for something like 12 out of 13 straight days. There was so much pre-selling in the market. I think you got to be really careful about getting too bearish right here, even if you don't believe in tariffs. Okay, just because usually by the time the news gets announced, you heard the old phrase, buy the rumor, sell the news. We think this is more the case. The people are selling ahead of the rumor, and maybe you might see buying on the news. We want to let the data tell us the tale, though, right? That's just kind of my opinion, kind of my feeling, like the contrarian in me that says, yeah, there's probably a positive surprise coming here. But in the meantime, let's say, how can we start to make sure that our indicators are lining up with that potential expectation that maybe things are too oversold and too washed out here? One of the ways I want to do it and show you how to do it today is to cut through a lot of the noise, cut through all the hundreds or thousands of theoretical names you could be trading in the markets and get your focus back, laser focus in on one name that I love to trade. And it's the QQQs, the options on the Qs. That's the NASDAQ 100, right? I mean, here now you're talking about Apple, Microsoft, Nvidia, Tesla, whatever your feelings are about those individual names. The beauty of trading one vehicle of the biggest 100 NASDAQ names is that it smooths out some of the individual stock by stock volatility and allows you to start focusing on what they're doing as a composite. As we know, they've been big drivers of not just the NASDAQ performance, but the S&P performance of the last couple of years, as they're called, the Mag 7, Magnificent 7. Those big names are some of the biggest in the QQQ as well. We're going to talk about a couple of different techniques we use to trade the Qs on an overnight to 2-day hold basis. So quick swing trade, no day trades with this strategy, using Larry Williams' %R, percent range indicator, and then the ATR, average true range indicator, which is basically just a volatility measure. And so I'm going to walk you through that, show you how I trade it, how you can start trading and taking advantage of these moves without getting hung up on the news, the noise, the distraction of hundreds of names, and focus on one. Just a quick reminder, the information that I share with you in today's presentation is based on our proprietary research. It's intended for illustrative purposes only, not considered specific investment recommendations here. As you know, stock and options trading, they've got large potential rewards, but we all know they've got large potential risk too. We're going to talk about both sides of the coin here, risk and reward today. And then the past performance of any trading system or method is never indicative of its future results. The idea is that future results are going to vary. Could be worse than what's shown at times, could be better than what's shown at times. But the idea is that you've got to have a game plan to guide you through. See our terms of use on the BigTrends.com homepage for more information here. So everything we do is systematic. We don't want to be subjective. Even if I have a subjective opinion about what I just shared with you about the pre-selling and maybe the positive surprise to come in the face of the tariff announcements, is to say, you know what, let's just watch what the markets are doing. Let's watch the patterns. And we look for potential doubles with these QQQ short-term options. And these are quite short-term. We're talking about 3 days till expiration. We're never going to hold them more than 2 days, right? So we're going to walk you through how that works and show you a bunch of case studies when it worked, also when it didn't work, right? How do we manage winners and losers? We call this strategy QQQ Options Playbook because we give subscribers our entire playbook for your own internal use and knowledge, right? We always want to build your knowledge. And so for me, it's always been about that. I'm going to share with you how you can start getting trades as early as this afternoon. But bottom line is that we'll only make a trade when the system says that there will be days where we don't have a trade, okay? That's part of good trading too, is knowing not just when to trade, but when not to trade, okay? So I've been trading stocks and options for over 35 years. I caught the trading bug while I was a student down at Duke University, and I got in a trading contest and took the Warren Buffett approach and was doing terrible. Then went to an active trading, day trading approach at that time back in 1988 that took me from the bottom quartile to the top 1% of the college students in this contest, and said, hey, I like this. This is what I enjoy doing. Once you find your passion for something, there's nothing like that light bulb going on to say, this is what I want to do, and focus on how to help other people do it better, right? So that's the goal for us, is that nothing is subjective, everything is systematic. but it's all about having some unique edges. We're not going to try to do everything like everybody else. We're going to try to have some different things that we do to have some edges that you can create in your own trading. So let's kick off today's event with a winning trade example we recently had here. Everybody was worried about the Qs and worried about the markets. This is an example where we've got the percent R in this bottom panel. Now, let me just explain what percent R means. Percent range, Larry Williams developed. I know Larry, he's a great trader, great guy, and a great innovator, right? Percent R, when we say percent R, we're talking about the percentage that the stock is traded high to low. If I was just looking at a 4-day percent R, which we look at quite a bit longer than that, but you can see the low on this chart here is down around 472. The high on this chart is up around, just for an example here, 485-ish, right? So if we took 485 minus 472, that would be a 13-point range. So where we close within that range would then give you a percentile from 0 to 100%, the way we like to show it on a positive scale. Larry uses a negative scale. I've always been more a fan of the grade school scale. We're looking for some unique patterns here. One of the patterns is the classic kind of oversold pattern where you can see on this particular day back here on March 18th, we had a red candle here. You say, oh, red candle, that's bad, right? That we had a close below the open. While that's true, it's not bad in our view, and if we have the right pattern. You can see we weren't making new lows here. We were setting up in the bottom 20% of the readings, and our data said that we've got a good chance for a bounce back. There's other times where we will trade the strength as well for a bullish trade. But in this trade, we said, okay, that was March 18th. So we said, go 3 days out till the expiration of the option you want to choose. So the 3-day rule for us says if it's March 18th, go by March 21st. Now, why would we only give ourselves 3 days? A couple of reasons. We want to not have to pay as much time premium overall. We want to get better leverage because of that. We'd never, though, want to hold the options on the 0 days expiration. 0 DTE expiration date would be March 21st. So we'll never hold it past the end of the day on March 20th, 2 days after we got in this case. So the 2-day rule is one of our key rules to say, don't take that final day of expiration risk. It's not worth that more dramatic melting ice cube of time here. Now notice, where were the Qs trading when we got in that last half hour of the trading day? We were near or just over 474. Now you can see what we bought. We bought a 476 call. So that's a touch out of the money. But our data said that we had a good chance to snap back towards those old highs. And our objective is whatever we pay, which we typically want to pay $5 or less, we get at least a couple of contracts. But the idea is that we're going to pay something that's based around the average true range and expecting how much of a move relative to how the Qs have been trading. And so what does average true range mean? It means that if you take the high and low and also add in any gaps, it will give you what's the expected range day by day, and then you average that out over the last, if you look at 5 bars, 10 bars, 20 bars. I just for an example, I pulled up a 20-bar daily QQQ average true range calculation just now on my other charts here, and said, you know what, the Qs right now have just under 11 points of average true range on a 20-day average. Looking back, obviously the last 20 days, about the last month, quite volatile on the downside, right, with the market pulling back ahead of the tariffs, the pre-selling that I'm talking about. But that 10.77 points equates to about 2.25% on the Qs, which are trading right now about 472.5. And bottom line is that what that means is that's about double what it was back about 9 or 10 months ago. Back last May, we were trading literally half those levels. So volatility has definitely jumped. And so what that means is that to keep your option prices around $5 or less, you're going to pay a little closer to the money or even slightly out of the money. That doesn't bother me as long as we can get there quickly on our target. So what happened here? The very next day, we snap back up, right? We go from 474 the next day. We do have that bounce. You see it trades up to about 485 at the highs. And you think, well, 485, if we're in at 487, we're targeting a double. You just multiply your entry price times 2, right, to get your double target. So our double target is 974. And the beauty of this is that we were worth at 485. If you've never traded an option before, let me just quickly remind you, you buy a call at right to buy it at 476 on the Qs. One contract controls 100 shares. So remember, you're paying $487 on one contract to control 100 shares of stock that would have cost you about 47.5 grand, right? So you're talking about 100 to 1 theoretical leverage. We get a snapback. You can see 9 points up, almost a 2% rally gets us 100% gain and that ends up being about a 50-to-1 leverage effectively, because you do lose a little bit of time premium as you hold these trades, right? But the goal here is take the bird in the hand of the double. We're going to target on our stop losses, we're going to target half of what our target is. So we're going to target a 50% loss versus 100% gain. So that even if we're in that 50-50 win rate, you can still make that work for you by making twice what you risk. Okay, that's the objective. We're not always going to get the upside profit target. We're not always going to get the downside stop loss. Sometimes if we hold the trade for 2 full days, by the end of that second day, we will get out. So in this example, we're just assuming if you put in $1,000 a trade, what would that make you? Well, that would make you $974 because you would have gotten 2 contracts in for $487 a piece. That'd be a $974 investment on the way in. On the way out, you get back about $1950, $1948 officially. And again, commissions are next to nothing these days for options. In my 35 years of options trading, never a better time than now to focus on options, because of course it's a buck a contract per side maximum, and as you get more active, those rates can even go down. No ticket charges anymore either. So it's a really maximum round trip on 2 contracts in and out, $4, right? So you made $970 net on a 24-hour hold. We'll never have a day trade with these trades because we're going to get in the final half hour. So some of the strategy guidelines here: 2 days or less hold, no day trades. We've got actually 3 different percent of our patterns. 2 of them are bullish and 1 of them is bearish. I'll show you those other patterns here. You learn all of the rules of the system when you become a subscriber, and I've got a great intro special for you here in just a little bit. But the idea is that it's simple, straight options purchases, buying a call, buying a put. While I'm rolling here, let me also get your feedback. I've got a great crowd in with this. How long have you traded options? If you've never traded an option before, type a 0 in your chat box. If you trade them for 20 years, type a 20. I love to know how many years you've traded, or if you're brand new to it, don't sweat it. We keep it really simple. For a lot of people, the 3 DTE, 3 days expiration, seems very aggressive, right? A lot of people would say, fine, start with a multi-month option holding period. But the problem is we've got a 30-year trading veteran in David. Congrats, David. Rivaling me with my 35 years, right? And when you've been trading that long in options, you've seen a lot, right? So you know the importance of risk management. I would attribute that in my 3.5 decades, the risk management piece being one of the key rules of staying in the game for the long haul. Never going all in. Capital allocation becomes a really important thing. I'd rather see you trading small to start building your confidence, to manage the risk, and ultimately understand what it looks like both when it works and when it doesn't. But the 3 DTE expiration for us means we're not going to have to get too much time premium and thus cut down our leverage too much. But I would also say if you're just getting started, you're dipping your toe in the water, you can always watch it first. But of course, there's nothing like having a little skin in the game when you do decide to get started, even just trading 1 contract at a time and getting used to that discipline of execution. That's what we do at BigTrends now in our 26th year here at BigTrends, is guiding folks through on the system so that all you have to do is execute. When we say get in, here's where you get in. When we say get out, all your job is just to execute those signals. That makes your job a lot easier. You get the emotions, get your ego out of your trading game. Ego has probably cost me the most money in my trading over the years. When I thought I was right, when I thought I knew more than the market, my early days of trading, I was almost always not right. I was almost always the market knew better, right? So we don't want to fight that. We want to get in tune with that. So that's what this whole process is, tuning yourself up. Give your trading a tune up so that you can get in tune with the markets. Okay, so daily chart, once a day, Monday through a Friday, action point right near the close. We look at it real closely around 3:30 internally here. You know, we don't want to overreact to what's happening in the morning. And you know, today obviously a great example with Trump supposed to talk about the tariffs at 4 p.m. right as the market closes. It's going to be really interesting. But here's a little aha for you. You think, okay, well, the cash market closes at 4 o'clock. You can't trade, you know, a lot of these vehicles past 4. Maybe there's some after hours trading in stocks or the Qs. But the beauty of the options market is the options market, even as the cash market closes at 4, the options market on the Qs will stay open every day until 4:15 p.m. Eastern. A lot of people don't know that. So it's important to be aware of that. We could be seeing reactions in the QQQ options market even after the Qs close at 4, right? Based on good or bad news, based on less or more tariffs, right? So that obviously creates both opportunity and risk, right? And so again, I say, you know, make sure you can manage your risk. But part of it is that's why we give it a 50% width on the stop. And that's why I always tell subscribers, if that's too much width for you, And you usually trade a couple contracts at a time, and maybe you use a 25% stop. Well, 2 contracts at a 25% stop is kind of the equivalent of 1 contract at a 50% stop. So just cut your size down and still participate in the signals and follow the system, right? This is about building the discipline of continuing to following a system, but make sure it fits your risk parameters, of course. So that makes our time really effective. Also, you don't have to screen watch with this. You know that our trades alerts will be sent out at 3:40 p.m. both to get in, and if we're still holding something that hasn't hit a target or stop 2 days later, we send a reminder to exit at the time stop 2 days later at that same 3:40 p.m. Exit. So remember though, that sounds tight, but the 4 o'clock cash close, but that's 20 minutes of the cash close, but 35 minutes till the options markets on the Qs close at 4:15. So plenty of time to get in with a real-time email. You can also get text alerts sent to you via real-time email to your mobile phone as well. No additional charge from us. So, we use the WhatsApp technology for that. So the goal here is to get enough trade frequency. We're looking for typically a couple trades a week, about 8 trades a month. There may be weeks where we have more or less, right? We don't want to force it. We got to get both the quality and the quantity working for us and for you as a subscriber. So we want to get more bang for the buck. That's why we use these relatively short-term options while still having enough runway to get a move over the next couple of trading sessions. So if we got into something today, I'm not saying we will, but if we did, you say, well, here we are on a Wednesday. What expiration will we choose? Well, you go Thursday, Friday, Monday would be 3 days, would be Monday, April in this case the 7th, right? So you say, okay, that's the objective here, is to say we wouldn't hold it into Monday, we would be out by Friday's close at the latest. Notice the average contract price going back to the beginning of 2023 in this system and has been $3 even. That means $300 a contract. That means if you're putting $1,000 in to start, you could start with 3 contracts on average, but again, sometimes it might be more or less depending on what we pay going into each trade. But I would much rather see you not say take a set number of contracts. I'd rather see you take a set dollar amount to get your dollars relatively stable and consistent on a trade by trade basis. That way you're not too overweighted or underweighted to one signal or another. You want to be kind of balanced because we can't predict the individual signals. The idea is that we're trying to play for an edge over a longer series of trades, right? So, but when we get a signal, we know that over time we have an edge. Our job and your job becomes to extract that edge. Like I said, 2 days later, if we haven't hit a profit target or a price stop, and avoid the final day before. Don't hold in the final day of an options life with this strategy. So why should you care when you look back? Again, past performance, right? So past performance can never guarantee future results. Future results will vary. But if you started with a $25,000 model portfolio, and remember, we're going to only have one trade at a time here, right? So we're not going to be ever like totally invested. $25,000 portfolio. What's interesting about this is we use no compounding. We said if you just started with $5,000 a trade, so you start out with 20% of your portfolio going to a trade, but then as it grows, you keep it at $5,000 a trade. You're actually getting less and less risk in a growing equity curve on each successive trade as a percentage of your portfolio. Same fixed dollar risk, but less of a percentage risk in a growing portfolio. The goal of that is to not give back your hard-earned gains too easily. If you're trying to compound your amount invested per trade, when you do run into a drawdown, it'll hit you harder if you're compounding it. So we didn't compound it. We said, let's just be consistent. Same up to $5,000, no more than per trade. $25,000 portfolio grew to over $126,000. That would be up 407% growth. So again, this is before commissions, which have come down dramatically, and before subscription investment, which again, that's also come down dramatically. Got a great starter special for you. But the beauty too is that you can trade a smaller account, right? So if you say, oh, I don't want to trade a $25,000 account, I'll trade a $5,000 portfolio. Well, here's a $5,000 portfolio. Not quite up as much, right? Instead of 407, it's up 357% gross. Why? Because if you're just trading a smaller amount, you won't get quite your total full percentage of cash invested per trade as you would with a higher dollar amount. So, but the idea is that you're getting close enough that you can say staying with just a fixed $1,000 a trade, a $5,000 account grew to over 22,800, 17,865 gross profit since January 23, with the same caveats. Past performance can never guarantee future results. What we do assure you though is we're going to follow the system, win, lose, or draw, through upside moves, through downside give backs. We're going to stick with the system and be consistent with our QQQ options playbook trade alerts. We call them out to you no matter what, when to get in, when to get out, and you're never left hanging, never wondering, what do I do next? We guide you through from the beginning to the end of every trade. Now, the interesting thing is that when combine the indicator of percent R, we do the ATR, average true range, to kind of calculate which strike price makes the most sense. But percent R, the percent range indicator Larry Williams developed, is something that we then tweak and then tie it in with the actual price action pattern, the candlestick pattern. How are we opening versus how are we closing? How are we gapping? Are we not gapping? Those kind of combinations of patterns actually give us 8 different categories, of which 3 of those 8 are tradable patterns. But the big thing, so our prior speaker also used this on his chart. He had a historical profit factor. We do the same thing. We look at the historical profit factor, which takes into account not just your win percentage, but also when you're right, how big are you right? How much do you win when you're right? Your average winning size compared to when you're wrong, how hopefully smaller are you wrong, right? If you can let your winners be bigger than your losers, you're not going to have to sweat having to have a super high win rate, right? A super high win rate's nice, but what I see with a lot of super high win rate systems is that they win a lot, but then when they're wrong, they get cremated. You get killed on a lot of these systems where they're either giving themselves a wider berth before they have to stop something out, or there's betting that's going to eventually bounce back, and sometimes it doesn't, right? So we don't want that. So the idea here is that we want that consistency. The great thing about the recent pullback is we don't have to catch all of it to still get a healthy opportunity here. So this is a trade that we called out during the downtrend where we got a bounce, but our data said when you've been broken down and staying in this oversold bottom 20% of readings, which really was happening here from about Feb 27th. So you see, not really calling the top here, but basically saying that this is your steadier part of the down channel back in this phase here. And when we get the bounce and you're staying in the relative bottom 20% of readings, that bounce still making a lower high. Basically, that bounce into the close says, you know what, about 492, we're going to buy a put and bet that we're going to snap back down to at least test the lows. If not, in this case, you see the next day it did undercut those lows. So we bought the 488 puts. That was March 7th. And we had the weekend, right? March 8th and 9th were weekend days. So you count out the 10th, 11th, and 12th, Monday, Tuesday, Wednesday, the next week. That was our expiration here, Wednesday, March 11th. You can see, though, that we were already out of it on that follow-through day on March 10th. When we gapped down, you can see that's a big initial gap down. We had closed at 492 or so. We opened under 485. And then, of course, we traded all the way like 474 on that Monday. Now, we didn't get all that move, right? Because remember, we're buying this 488 put at 509. So it's just over our $500 usual goal. Said, well, we don't want to miss it. So let's go ahead and take advantage of this. Even with one contract, if you're putting $1,000 in, I want to get you one contract, not two. If you're following the rules exactly, you know, then you say, I don't want to round up above 1,000 maximum exposure. So let's buy the one contract for 509. Next day, pops down. Those are cashed out at 1018. Doubler on that follow through day to the downside on Monday. So again, didn't really get the maximum on it from a capital allocation standpoint, but still $500 profit for a next day hold, right? Here's another bullish pattern, but this is actually when things have been strong, right? So when you see breakouts, and again, breakouts like you saw this surge in the Qs back here in earlier February, and then you see that we're kind of, even with this little pullback day here, we're staying in the top basically 20% of signals. It's kind of the 80-20 rule, right? You stay in the top 20% of signals, you're seeing that things are still acting very strong. So we're coming off that support. We're getting a nice actual reversal where we open lower and then kind of big flip to the upside. That kind of fit our parameters to say, hey, this is a sign that this is actually ready to go more to the upside. Qs were trading near the close there, just over 528. About the 530 call is 3 days out till expiration. Had a holiday in there with the so President's Day holiday, and then say, okay, so we get the 18th expiration, but we're in that trade on the 12th, out the next day on the 13th. As it's, look at the pop up, goes 528 and change, goes up to about 534.5, right? About a 6.5 point move, just over 1% move in the day. And these 299 options were cashed out the next day for 598. So you can see also, thinking points here for a second, if we go up in this case about 6 points, we get about 3 of those points on the option, right? So that would be what we would call a 50% delta if you're getting, 3 of the 6 points. That's in line with what we'd expect with about an at the money option. This was actually slightly out of the money. So it definitely fit that, hey, you should expect to get around an at the money option about 50% bang for your buck compared to the underlying QQQ point move, right? So you think, well, I want to make 3 points on my option. Well, I'm going to need about a 6-point move on an at the money option to get that 3-point move in that option. So just keep that in mind. That trade, then you would have gotten 3 contracts in for $8.97 and you would have doubled it. So then you would have had $8.97 in profits 24 hours or later in that case, or less. But no day trades, right? We're going to get in near the end of the day, so there will be no day trades. Let's face it, though, not all trades are going to win. Actually, this was one that didn't hit its profit target, but did end up winning, but kind of a slower boat. So this is where the 2-day rule helps. So you can see that as we get in that late day, and a lot of people would see that pattern and go, oh man, isn't that a negative reversal? We were a lot higher and came down close to what candle followers would call a doji pattern. But we don't care so much about those individual candle patterns on a given day. What we care about is, look, we gapped up. Look, we still finished positive. Look, we're still sitting in this case in the top 20% of readings on the percent R down here. So the point is that it's still checking the boxes that this is a strong trend. So we got in there about 495 and a half. We bought the 497 calls, $3.50. Next day, it gaps open. You think, oh, good, we're going to make some money real fast. Well, it doesn't gap open enough, right? We go just over 498, and then by the end of the day, it's back to where we got in, right? So if it finishes where you got in the following day, guess what? You're probably going to be losing a little bit because you've lost a little bit of time value, right? But the following day, it does rally. We don't get stopped out. But again, this is the helpful part, is that we had a little pullback there where we were down about maybe a 1.5 on the Qs a day and a half later. And if you got too tight of a price stop, you'll whipsaw yourself out. So we've used a 50% stop loss. And I should have an example of that in here, but the idea is that they're going to happen, right? But the idea is that we are able to not get whipsawed, and then when it flips back up over 500, closes about 500, you say, well, that's worth about $3 intrinsically, but it's still got a day to go. So we get out at 519, make 48.25% for a couple of days, 48 hours held, right? We're going to be out about 2 days later, 2 trading days later at that 3:40 p.m. exit. So we call this strategy QQQ Options Playbook, with the objective to find 8 new trades a month, or about 2 a week. Like I said, some weeks might be 1, some weeks might be 3, but we think about 8 a month is reasonable. And this was an interesting one because, again, back in the fall, yeah, the Q's downtrending, and then we get the big reversal. A lot of people would say that big reversal, oh, that means we've had a major engulfing pattern candle fall, as we call it, right? We opened down here, we closed up here, so that's a big reversal, right? But problem is, you're still just about that 20 or 22 percentile here. You're still in that bottom 20% of readings, give or take. And so for us, that's a sign to get bearish for the next day or two, to bet we'd retest those lows or near it. We're about 268 there, and it even opens up about 271. So we're initially wrong on our at the money put. But since we paid just over 3.5, 353 a contract, I'll get you 2 contracts in on $1,000. And then of course you look at that and say, well, it doubles the next day as we snap down to 260, right? At 260, those are worth 8. We were out at 706 for the double, and that would make you that $706 profit on 1,000, or in this case, $706 invested. Couldn't get the 3rd contract. That would have pushed us over 1,000. So here's right before the election, right after the election, back in early November, and we actually got both of our bullish setups triggering. The first one was coming off of the oversold zone here, showing that we're holding up on a close-to-close basis, and showing us that at 486, we think we're going to rally. And in this case, we did rally the very next day, the day before the election happened that night, right? That was coming into, you can see that November 7th was the expiration there. We bought the 491 calls, about 5 points out of the money. The volatilities were juiced right in front of the election, right? But the beautiful thing about that is that if volatility is juiced and you can trade in and out before that event, volatility shouldn't change much. Maybe it even goes up. So, but the idea is that you won't lose much on volatility if you hop in and hop out before the event, okay? In this case, we were able to get $401 a contract, 2 contracts in at 802. You end up making just a little over $800 on the trade the next day as it snaps up to about 492. So think about it, we went from 486 to about 492, 493, more than a percent rally, right? and that's good for 100% on those options. Then we don't trade on the election gap here, right? Put a big E on it that night into the next morning. There's your election gap up, right? We're not in during that day, right? There was a lot of event risk, and we said, okay, let's just wait. The system didn't really signal either, but then it goes into the strong bullish mode and it finishes near the highs and breaking out there past all the old highs there, right? And so near almost 506, we say, okay, now volatilities have come in where we can buy a 1 point in the money option the day after the election reaction and say we can catch some follow through there. Paid about the same price we paid before, 409. Now we're a point in the money. So volatilities have definitely come down and adjusted post event. And then we doubled it that next day as it went from 506 to 514, right? It still rallied more than 1%, and you made 100% on that next one as well. 818 bucks invested, cash it out for 1640, right? So that's make over $800 on that trade from one day to the next. The idea of all this is that, of course, we've got to follow the system because there's going to be winners, there's going to be losers, right? But the key is we want to keep our loss around a 50% loss. So here's an example of a losing trade. This was back above the top 20% of readings over that 80 percentile here. We're staying in a pretty strong close here, looking like we're about 509, 509 and a half. We're buying the 508 calls. We thought these were cheap options, right? Maybe they were cheap for a reason, right? About a buck and a half in the money. We only paid 333. So you get 3 contracts in for 999 bucks on $1,000 maximum commitment. And then the next day it opens a little lower and just keeps going against us. And so intraday we're going to get stopped out here probably just under 505 on our 508 calls, going from in the money to slightly out of the money, and that $1.56 is triggered. We hit 53% give back, and we say, good, get rid of it. Never hold, never add to a loser. Just basically say, if it hits your stop, take the hit. Say that's just part of a good trading is follow the rules, take the hit, and move on. Okay, but sometimes you also get gaps past your target as well. This is one that had a really bullish setup here back in September. So again, what do you see here? You see your gap up. You know, you've heard about flags, right? So there's your flagpole on that gap up, right? And then there's your flag forming of those next 3 or 4 days. We're kind of actually edging a little higher. And so that flag kind of congestion pause phase is okay. And our system says, hey, it looks like it's really ready to go again here, just over 485. We buy the 484 calls for the end of September expiration, pay 391. So you get 2 contracts on $1,000 invested for 782. Close the next day. We're targeting that it goes up to 782, but look where it opens the next day. It opens at 955, right? Because the stock or the Qs went from 486. Next day they open 493. They're already up some 7 points or like 1.5% on the Qs. We ring the register in those situations. That's just a windfall profit beyond our target. You don't ever try to sell part and hold the rest. You just take the whole thing down at a double, or in this case, better at 144%. So a lot of people would say trading these 3 day sale expiration options would be aggressive. It's certainly not for widows and orphans, right? I mean, I'm not advocating that it's for everybody, but what we found is that if you can just, follow when we say get in, we say buy this option up to this price. We say get out, it's like it's time to sell this option. Let's get out of it. You've got your profit target, you got your stop. So we remind you on all that stuff. So, okay, then it's just a matter of just executing the patterns, executing the system, knowing when to trade, when not to trade. Like we said, $25,000 portfolio grew to $126,842 for over $101,000 gross profit before commissions, before subscription investment, back to the beginning of 23. So we've got 2.25 years under the belt in the system. That's assuming you allocate $5,000 a trade and never deviate from that. You don't put in more. You just go up to and never more than 5,000 each trade on however many contracts you can get relative to the interior prices. I always encourage traders getting started to trade smaller. On all these examples, past performance never guarantees future results. So if you're trading smaller, remember, okay, a $5,000 model portfolio grew to $22,865 gross before commissions, before subscription investment. That never bumped up the $1,000 maximum. So now, if you're at 22,000 plus, you're putting in $1,000, you'd be putting in, you can see, less than 5% of your account per trade, right? So you're looking at that and saying, okay, that's how you can manage your risk, let things keep growing, but also not get too high or too low off of a recent run up or even a recent give back phase. Of course, past performance never guarantees future results. So when we show you these, just a reminder that that's what the past was. The future is going to vary, but what will not vary is our commitment to following the system. I'm kind of getting tight on time, so let me share with you how you can get these real-time QQQ options trade alerts with our strategy. Never be left hanging. 3 months of trade alerts is what I'm recommending for you, because I'm going to give you a super special where you can get it for less than the normal cost of 1 month. Okay, so I want you to have more time as part of celebrating the good folks at Festival Traders and Dave having me here today. Bottom line is that, look, you also get extra things. You get a lot of educational support. So it's not just a black box system. You learn the system with our settings and rule sheet. I give you from me directly. I don't farm this out to somebody else. I do the weekly video coaching updates. So you know exactly how to learn from me in my 35 years of options trading, how we're going to trade the Qs for the week ahead and recapping what we did in the past week. And you get dedicated email support with me and my analyst team if you've ever got a question. Like if you went on our website and bought it off the website, you pay $297 a month times 3. You pay $891, but I'm going to slash that for you today. We're going to take it down from $891 to only $177, more than $700 off, and even better, think about it. You're getting it for the next 90 days for less than $2 a day. So if you're wondering how to navigate the markets, navigate the news, whether it's tariffs or the other latest things that are popping out there, not just here in the US, but around the world, I think the Qs give you one of the best ways to diversify, trade it, get plenty of bang for your buck, manage your risk, and give you a whole lot of ways that you can take advantage of it. So when you go to that page, it's members.bigtrends.com/festival. We've already taken all discounts. So basically on that page, you'll see that you can actually, pay by PayPal on the bottom right of that page, or that's a secure page. You can pay right on that page and go ahead and lock in $891 of value for only $177. It is not an auto renew. So basically just try it for the 3 months. If you like it, you can call our 800 Big Trends number. We'll guide you through how to re-up and renew. I think you will like it, but that's why I'm giving it to you as such a slam dunk starter price point to say, I want to keep the vast majority of your money working hard for you in your trading portfolio, but know that you get our support. Like I said, 26 years in business here at BigTrends.com. We're there for you. We support thousands and thousands of traders with clarity when it comes to not noise, but actually always reminding you what to do, never leaving you hanging, and keeping you focused on the best opportunity. So I'm going to hand it back to Dave to keep him on time. Thank you for having me, Dave, and always a pleasure to be with you. Go check it out. And on that page, you'll see our 800 Big Trends number. Call us if you've got any questions.